Thank you very much for your time, and I know that it's important. I would like to go over a exercise within your textbook that will demonstrate what you'll need to do when you record transactions. I think the questions that I'm going to ask you and present to you while I'm doing this demonstration, you should ask yourself when you're working on your transactions. This particular exercise is going to be coming from your chapter 2, which is recording transactions. Now in chapter 2, it's going to talk about so much. One of the things it talks about is double entry accounting. And double entry accounting really requires the user to have equal in terms of dollar amount. The debits have to equal the credits. So if your total amount of debits is 54,000, your credits have to total 54,000. Not the number of entries or accounts that you affect, but the dollar amount has to agree. So we're going to be working on double entry accounting. Remember, the rules of accounting, particularly thus far in the course, is we want to record our transactions when our expenses have been incurred. That means we receive the benefit of it, or when we've earned something. So if you've earned something, it doesn't matter if you receive cash or not. The fact that the earnings process is complete, that you've done the work, that you are entitled to some form of asset, most often it's going to be cash. So the first transaction, if you can see here, you see here is 1, 2, 3, 4, and you also see debit and credit here. I'm going to switch between two different Excel spreadsheets so that we can go over the different transactions. So here it says bill customers fees earned for $54,100. Well, that's important to note. You billed them, but it doesn't say anything about receiving cash. It does say you've earned something. So that means you earned it. It's like, okay, that means that's income. Oh yes, that's income to me. Then it also say you've billed them. It doesn't say that you received cash. So if you earned $54,100, but you haven't received cash yet, you're going to be expecting cash. So I'm going to use accounts receivable. And I'm going to expect $54,100. So far, so good. Now, you've earned the money. You performed a service and you've earned it. So if you earned it, that means it's some form of income. Fees earned, $54,100. See? Now not only have we shown that we've earned money, revenues, we increased the revenues, but we also show that we have an expectation of money's going to come in soon, a receivable. All right, let's try another transaction. Purchase supplies on account. This is so important. Purchased, that means that you are buying something, okay? What are you buying? You're buying supplies. But it doesn't say you bought the supplies for cash. It says on account. That means that you received an asset, but you have not paid for it yet. That means a liability is established. So let's record that entry. We purchased supplies on account. I want to first show the asset that I've received, and that asset is called supplies. And if my memory serves, I believe it's $2,100. No, $1,250. Okay, let's get that right. $1,250. I'm increasing my asset called supplies. Now, remember, we haven't paid for this in cash. We have not paid for this. It's on account. And whenever you see on account, you know that at some point you have to pay for it later. So accounts payable is my offset. I'm increasing my liability because I'm crediting it. I'm increasing my asset because I'm debiting it. Rule number 1, assets are increased with debits, decreased with credits. Rule number 2, liabilities are increased with credits and decreased with debits. Rule number 3, revenues are increased with credits and decreased with debits. Rule number 4, equity is increased with a credit and decreased with a debit. Very important rules to remember. They will not change. Okay, let's try another entry. Receive cash from customers on account. Now remember, you billed the customers $54,100. You have not got the money at the time you billed them, but later on you did, because it said you received cash. That means you are going to increase your cash, and the cash is going to be received. But what about this one? From customers on account. This is important because the customers did receive the benefit of your work. You've earned the income, but they asked for a little bit of time to pay you. So I said, okay, well, I'm going to put that in accounts receivable, and I'm going to show that I've earned it. Now I have to show that I'm receiving my money, and I'm going to show also that the receivable that I'm expecting from them is going to be reduced because they are now paying part of what they owe me. In this case, $43,800. So far, so good. Let's do one more entry. The next one, it says, paid creditors on account, $600. Now, paid is a very important word. When you pay something, you have to assume, in this course, paid means you wrote a check. So you are going to be releasing $600 of cash to a creditor. Now, the creditor, in this case, is the accounts payable. So not only are you reducing your cash, I'm going to sit here, my cash is going down by $600, but also I don't owe my creditor as much. I'm going to reduce my accounts payable. And as you can see here, I reduce my payable because liabilities are reduced with debits. And if you can see here, the left-hand side is going to be the debit side. The right-hand side is going to be the credit side. Now let's take these transactions and let's transfer them or post them to a ledger. By recording the transaction here, we now have to transfer it to a ledger. Each one of these accounts are little ledgers. So I'm going to record some transactions to show you how to transfer to a ledger. In your project, they are called T accounts. They look just like little T's. So my cash account is going to go up by $43,000, $43,800. My cash also goes down, if you look at the other transaction, by $600. What else? Well, we got our accounts receivable. That went up by $54,100. It also went down here, $43,800. If we go to the next one, we see our fees went up by $54,100. And again, debits on the left-hand side, credits on the right-hand side. Same rule. Our supplies went up by $1,250. So we recorded this transaction, we recorded this one. Let's see, oh, we haven't done our accounts payable, $1,250. So far, so good. And then finally, I think we have an accounts payable that's going to go down by $600. And cash goes down by $600. So if you look at these transactions to make certain that I didn't miss anything, the first entry is accounts receivable of $54,100 debit, credit of $54,100 to fees revenue. That entry is done. The second entry is supplies. We debit that for $1,250 and we credit accounts payable for $1,250. Entry number 2 done. Cash, we debit it for $43,800 here, and we reduce our accounts receivable by $43,800. That's done. And our final entry, to make certain that all entries have been posted and recorded, accounts payable is decreased by $600 and our cash goes down by $600. We have now not only recorded journal entries, but we actually posted them to their accounts. Hopefully this will be helpful to you, and my urging is that you review these transactions over and over again, as they will be repeated with different dollar amounts in various assignments throughout the term of the course. I hope you have a great week, and ask any questions that you have, and I will be there to help you. Thank you.